Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, September 16th, 2022. S&P 500 currently sitting at 3846. I'm David Zarling. I'm here with Ian, everybody's oasis and sanctuary, McMillan. Ian, would you be okay if I started with a little bit of a commercial?
Yeah, go for it.
Because I know we're going to jump into stocks, bonds, crypto, you name it, in the next, 30 to 60 minutes and riff on that. But I figured if you're okay with it, I would like to talk about a charity that's near and dear to my heart called Beats for Heartbeats. And full disclosure, I'm a board member, one of the founding members of Beats for Heartbeats. And what is Beats for Heartbeats? It's an organization that supports abundant life. What is abundant life? It's a life that battles through depression and anxiety. It's a life that protects ones that can't speak for themselves. And so we have this event that's happening tomorrow, Saturday. It's an outdoor concert. Obviously, not all our listeners, we have a ton of them, can't make it to an event like that, but they can help support great organizations because that's what this concert is about. Do the services that they provide. An example of this is Beats for Heartbeats. Heartbeats Inc., the charity, sends funds to organizations like Operation Underground Railroad. What is Operation Underground Railroad? Well, I think we could all agree, those listening and yourself included, Ian, that sex trafficking, not really a good thing. And at the same time, it's one of those scourges on society that I don't know necessarily how to battle at a corporate level, or at a level that is beyond just making sure that my kids are practicing safe online practices. But as far as like battling it from a professional level, that's what Operation Underground Railroad does. And so that's an example of an organization that receives funds. Another example would be something like Christian Family Solutions, which helps people with counseling through depression and anxiety. And so this concert that we're putting on, we've done it for a few years now. It's a great event. We're at $35,000 raised. We'd like to get to $50,000. I don't want to take up too much of our listeners' time, but if they are willing to make a donation, they can go on the website to find out more. It's beatsforheartbeats.com, and they can read about who we support. And if they would love to give a donation, that'd be awesome. We have an audacious goal of getting to 50,000. So with that, Ian, I'll leave it there. If people are interested, go to beatsforheartbeats.com. We would love your support. Thank you for letting me do that, Ian.
I think that's really awesome. Very, very noble cause.
Absolutely. I think you and I agree that hiring experts is appropriate. I know that you have a pretty nice setup in your backyard, but I know that you didn't pour the concrete.
I did not, thankfully.
Yes. And I like my new backyard addition, a deck we put on. But that really wouldn't have been my expertise. And I don't really necessarily mean to commercialize the topic. I just mean that I also don't necessarily have the tools and skills to, for example, rescue someone that is caught up in sex trafficking
situation. Totally.
Right.
Yeah.
And I don't have the expertise. I want to be there for someone, but I may not have the expertise, for example, to help coordinate a foster care relationship or help do some pregnancy counseling. And so we want to pay our experts, and that's what Beats for Heartbeats is all about. So I appreciate you letting me do this. Let's talk stocks.
Let's do it.
Or bonds. Or crypto or commodities.
No one likes to talk about, we know what trends bonds have been in. We don't need to update anyone on what bonds have been doing. Yeah, broke below the June lows this week. On most rates broke above their June highs. I think Pratty had pointed out only the 10-year isn't there yet. Maybe it is today.
No, it's just there. It's just right there.
Just there. And then, bonds of most sizes and maturities all back to lows. Obviously, your longer term, TLT, also new lows.
Well,
So,
and if I can,
you can't.
okay, the 10-year that Pratty's talking about will be, I shouldn't say will be. We have a little bit of time yet before the Friday close, but the 10-year looks like it's about to close at a weekly closing high.
I would say the weekly chart's actually pretty darn nice.
Right. It's a weekly closing high we haven't seen for 20 years.
Yeah.
So on a daily basis, yes, but on a weekly basis, which I would argue weekly
10
closes,
10 years.
Yeah, has a higher, yes, thank you, 10 years, not 20 years, 10 years for the 10 years for the 10-year yield.
Yeah, 10-year high for the 10-year yield.
Yeah, it's good. Has a nice ring to it. And I know everybody's trying to pick a rate top.
Well, and that isn't it. And like, I mean, there's so much data right now being put out right now where this should be a top in rates, right? This move, I could have said this in July 2021. Rates have had a extreme move, or maybe more so April 2021-ish. But now the debate comes down where, yeah, you're really making a bets on whether the next 20, 30, 40 years is going to be different than the last 20, 30, 40 years, I think, in rates, because none of that rates are overbought stuff matters if we're starting a new trend. To me, it doesn't.
No. Well, and
that's big. And again, all this data about rates being overbought is just using a bunch of stuff that started in 1980. So,
okay, go there, because why is 1980? When you say that,
rates have only got of course rates have been oversold every time they got here over the last 40 years, given the macro trend that we've been in. But we talked about this last week on the podcast.
Yes,
these rates start moving up, you're going to have so many macro relationships, intermarket relationships that have been built up over the last few decades that are going to get blown out of the water.
Yep. And your point is,
there's going to be periods where rates go up and growth does amazing, and people are going to. I'm not saying that's going to happen, but there's going to be, I'm not think that's going to be the entire theme of a rising rate environment, but it's going to happen, and people are going to scratch their heads, and, there's going to be a lot of figuring new relationships out, I think.
Oh, for sure. And it's because, and you guys did a good job last week on the podcast. I believe you dropped some ages that you would possibly be in if you've been involved in managing money since the 80s. Like that would be the last regime. And we're really talking about like late 70s was the peak, late 70s into 81 was the peak in rates. But that cycle went on. We know that these things, because we're market historians, we know these things go on for 30, 35 to 40 some plus years. And here we've got a rate environment that we've broken a rate of trend on something like a 10-year yield that goes back to 1981. And so people aren't used to that conversation that we're having right now.
FinTwit will spend the first 5 years of this new cycle trying to pick the top in rates.
Yes.
Until they finally accept that things have changed.
Yep. And it's not lost on us that if you remember as a listener or as a client going into now, the COVID crash was a pretty significant event across many asset classes. But even prior to that, the months leading up to that, the story everywhere was about negative yields. Negative yields. Are we going to negative yields? Yet negative yields, because it was happening globally. And here we are just ripping higher after the great COVID crash of March 2020, where you saw the 10-year touch 0.4. And here we're sitting at 3.5.
Yeah, right. Because I remember one of the big cases made was, well, if the rest of the world's gone negative, obviously the US is, soon to follow.
Right.
And we got close, but never got there.
Never got there. And I think it's fair to note that some of these other areas globally have also seen the same yield rebound. And sometimes you get these extremes. And I think we would all make the argument that, yes, have rates moved a lot in the last 2 years? They have, but think about where they came from.
Think about that extreme low. I mean, we saw rates basically cascade from Q4 2018 through COVID bottom.
Right. Like that's equally as dramatic.
Your mortgage costs just as much now as it did 4 years ago. I know 6% seems extreme. Or I shouldn't use mortgage as an example because I think mortgage rates are a little different. But the 30-year yield is, we're breaking above that Q4 kind of top there, 3.4.
Right. Well,
and go ahead.
So I'm sorry. I was just going to point out that, people like to talk about the extremes and, rates have moved too far, too fast. Okay. Well, walk me through from on a 10-year yield, October of 2018 through March of 2020, we moved minus 87% in 100, or what is that? That's 487 calendar days. Yet we've rebounded equivalently. We're just a little bit above that level from November 2018 in 917 days. So the move down was way more extreme than the rise we've seen currently. So that the argument that we moved too far too fast, I don't understand that, because where were these people when the correction in rates was happening or bonds were moving so quickly?
They're celebrating their 3% mortgage.
Right.
VCs were celebrating their basically free debt, and the concept in the grand scheme of venture capitalism was basically free debt.
Right. Yeah, free debt, like being able to run a business with zero profits because you were able to raise funds for zero. And we're going to find out. We're going to find out when debt actually costs money, when taking on debt to grow your firm actually costs money. Who the
probably
firms
be
are.
good. Probably be good. Weed out some of the charlatans across a lot of industries.
Yeah, for sure. So I know that
I like how we said we were going to talk about bonds, and then no one wants to talk about them, and then spent the first 5 minutes talking about them.
Yes. I was just going to say, I don't think our clients and listeners were expecting to hop on here and be like, wait, it's been
the same story. Right? It's been the same story. Bonds are nowhere to be as far as clients are concerned.
Right.
And are we going? Think how many retirements were built on the back of fixed income, and and how much wealth was built on the back of fixed income, and it just makes me wonder what that means for. Really, your generation, millennials, Gen Z, if somehow fixed income just doesn't end up being a viable asset class, long term. Well, it'll come back. Maybe my grandkids, but if we go on a 30 to 40 year upturn in rates, there's a lot of advisors that are out there that are going to be scrambling, trying to find out some new, ideal portfolio construction between equities and.
Yeah, the risk parity between equities and bonds would be broken. The good news for retirees or those heading towards retirement would be higher rates are good. It's also an interesting reset for equities because right now, I'm really going to throw you for a loop here because I'm going down a fundamental thing with Franklin Graham and Warren Buffett. There's a hurdle rate, right? Because if you can hold something that's yielding 8%, then why would you own an equity unless you know you're going to get 8% return?
Money market peaked at 13% back in 80 or 81.
Yeah, so there's going to be a period for our own clients. And I know we had an email exchange with a client we love and respect this week that was just about the fact that, what are your thoughts on treasuries, and what are your thoughts on, on bond exposure? I love it once they stabilize, because
for the sake of cash flow,
right. But they got to stabilize first. You can't buy them. You can't, for example, using 30-year treasuries as an example, the downtrend hasn't stopped yet in the principal. So if you're putting principal to work to get a yield, the downtrend in 20 plus year treasuries hasn't stopped, or even aggregate bonds hasn't stopped.
TLT. So and here's your risk, right? As an advisor, with that mindset. So TLT still only yielding 2.1. You take another 210 bip hit in price. Now that your entire cash flow theory is kind of wiped out in my eyes.
Right. No, correct. You have to wait for what we call stabilization, the downtrend in bonds, which is causing yields to rise, to stabilize a little bit, so you can have some allocation towards that without having your principal just completely eroded away and wiping out the yield, is basically what Ian is saying. Mm-hmm. And so I look forward to owning non-sexy bonds once this downtrend is over.
And you draw and we can get on here and argue about diagonal trends and horizontal support and resistance. But when we talk about rate of trend, that's one of the clearest changes in rate of trend. You take the 81 highs right through the last 40 years, and on log scale, because we don't do any of that other mischief. Log scale, like an appropriate technician. And I'm telling you, rate of change is in the books. I'm sorry.
Yeah, no, there's definitely, so Ian, if I can, let's talk 30-year treasury bonds, TYX.
Still going on treasury. We're 10 minutes in, still going on treasuries.
Yeah, we're going to do the whole thing. We're going to do the whole thing, and people are going to just freak out. So we're above, like 30-year yields are the highest they've been since 2014.
Mm-hmm.
Now, we've broken a rate of trend that goes back to 1981. And everybody and their mother, I'm pretty sure I got a text from my mom about, like, when are these rates going to stop? I'm being a little facetious, but there's a lot of people trying to top tick these rates. What's interesting is if you put the TYX in a channel, meaning what's the rate of trend that goes on since 1981, the breakdown that happens in March of 2020.
Yes, I know where you're going, and I like this. The undershoot.
Yes. So you undershoot by 100. I'm going to use 115% as my number. And if you overshoot, right, because not only can we revert to the mean, we can revert past the mean. Believe it or not, and this is a little bit like, I say something like this and people are going to be like, this joker just said this. 6% is the overshoot. Equivalently, so the undershoot, meaning like we broke down in March 2020 out of that channel, was about 115%. If you measure that from where we broke out just recently in 2022, that takes you to about a 6% yield.
So 6% on the last time we had a 6% on the 30-year was
97.
Yeah.
Or even like, if you want to call it top in 2000 in yield. So that's a little bit fascinating that you could have an undershoot and an overshoot. And that seems a little fantastical.
And then we come back, yeah.
And obviously that doesn't happen in a straight line. And I'm not saying it even happens at all. But the fact that everybody's looking for rates to top here, and I get it, it's a conditioned environment where that's all we've seen for 30 years is rates go lower.
They've been solid money for 4 decades.
Right. So it's fantastic. And we did it. We made it like 20 minutes, and our listeners are like, wait, I just got a little pitch for Beats for Heartbeats. We talked about bonds. Can we please talk a little bit about equities. You ready to do that? Can we do that?
We can. I'm willing to.
Okay. All right. So, big picture, this leads me back to another client conversation this week, is just when we study supply and demand, when was it evident that a correction was upon us? Because we never know the market bottom and we never know the market top until afterwards. So to say, oh yeah, it's so obvious, like it is truthful to say we've been in a correction since the beginning of the year in the S&P 500. That's truthful. But to say that you knew it was a correction since January of 2022, it's a little bit of a stretch.
So I've got so yes, you're absolutely right. Here's how I would frame it from we're not really, I would say we weren't really too bearish in December or January. Getting into February is when we started to get bearish in regards to our portfolio positioning.
Well, and there's a reason for that, right?
And then I would say it wasn't really, this is a hard word to use. I wouldn't say the bear market was confirmed, and we did take out this level later on, but I would say early May.
Yeah.
We messed around 4180. I know that's a popular number, but 4180's been going on since February, March. And we got below there late April, built this little I don't know, what was it, 2-week consolidation, pretty wild chop around there. Back in late April, early May. And then you got the break. Yes, we revisited in late May, consolidated, broke down, and, we can all go look at a chart. We're all technicians here. But yeah, I would say and then I think that's what on this latest rejection, breaking back below 4180 was such I don't want to say obvious. Nothing is obvious in this game, but a pretty good indication that rally was not going to pan out.
Right. That thesis got evaporated in a few short days.
And it was a strong thesis. When we talked about, the breadth thrust, no one's going to argue. That move in, off the June lows into July into mid-August, not shabby. For being below a 20 or a 200-day moving average.
Right.
But we got there and we got faded, and the move back below, and in particular, it's late August 26th. That was the Fed day, right? That was Jerome, yep. I think. Yeah.
Yep.
This isn't anything to mess around with.
Well, and where I'm going with this is the comment, the S&P. So sometimes people use the phrase, the market's been in a correction since January. Now, two pieces here. It's a market of stocks, and the average stocks actually has been in a correction since February 2021. Mm-hmm. The S&P has been in a correction since January of 2022. And the only way we can say that that's the case is when we break below 4180 in May. We don't know this, in a 10 to 15% correction happens in many market years. Mm-hmm. That we then finish higher and the uptrend continues. The uptrend was under assault and a new downtrend was being established in that early May timeframe. Where am I going with this? It hasn't been exactly smooth sailing for trying to take a position either which way since May 6th or 9th of 2022 of this year. Meaning that's when we confirm that there's a downtrend underway. But we've had pretty good price whipsawing from that point forward. That hasn't made it necessarily an easy task of picking your winners and losers during that time frame. An example of this would be one of the areas that was weakest starting back in February of 2021 was innovative technology, innovative ARK, ARKK.
Yeah.
Which through May 6th had corrected about 70%. And so the technical analysis textbooks tell you that you should be shorting the weakest. which would have been ARK, right? Because by early May of 2022, ARK's down 73%, which is incredible. The S&P is down only 14%. So when we break down in early May of 2022, the S&P, many places would tell you, well, short the weakest. But the irony or the factual statement that markets are going to market, they're going to do what they want to do. ARK is at the same spot versus the S&P as May 6th.
So I love that, Dave. And to add to your point, another area that was incredibly weak on May 6th, in fact, broke to new relative lows and broke down to new relative lows the day after. I mean, you want to talk about a horrible relative downtrend that had actually been going on for even longer than just ARK, was biotech.
Oh, yeah.
Biotech since May 6th has outperformed the S&P by 16%.
So the weakest didn't actually turn out to be the things that you could short during this period.
Yes, that is true. That's a good point. One of the areas that has been consistently weak and has remained consistently weak through the entire thing is cannabis.
Yeah. Yeah.
So you tell yourself, okay, what vehicles can I use to take advantage of shorting cannabis? And there's, I believe, one. So if we look at something like MJ, I think it's the cannabis ETF that's been around the longest, or you want to call it alternative harvest for
yeah. No.
Yeah,
right.
But it's the one that's been around the longest. Again, breaking to new lows today. So if you're going to use something like this to say, oh my God, cannabis continues to just be horrible, even during the July rally, it was pretty abysmal from a technical perspective, didn't really regain too much, broke down early, blah, 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 all the things you would look for. So, okay, how as a portfolio manager, can I go out here and I can say I want to short this area of the market, which is one vehicle.
Yeah.
And its ticker is MJIN.
Right.
And it is made by the exact same ETF issuer that makes MJ. And pull those two charts up as MJ again breaks to new relative lows today. And MJIN sits 30% below its highs. I'm sorry, I meant new absolute lows. MJ breaking to new absolute lows. MJIN still 30% below relative highs. So there's another point. Sometimes you can have a thesis and the tools available to you just don't really get the job done.
Yeah. And that as a portfolio manager, that's what we get paid for, is to understand when a vehicle is working and when it's not, when you're trying to express a thesis. And sometimes the vehicle works that you're trying to express the thesis in, and sometimes it's not.
Yeah.
And, markets are going to do their own thing. Many would say, well, just short the weakest thing when the market's in a downtrend. Well, the fact remains that places like IPOs and ARKs haven't been the weakest since May 6th when the breakdown in S&P 500 happened. And sometimes the weakest things that you try to express a thesis in, the vehicle doesn't work as expected.
Well, and doesn't that go back through something you've harped on we're almost at 3 years of doing the podcast, that, hey, each chart on its own merit.
Yep.
You can have all these other things shorting the weakest area is a solid foundation of technical analysis, but that doesn't mean without looking at the chart, you don't, you got to see if that's being confirmed.
Correct. And then if we can take this to maybe second or third level thinking, some would say, well, isn't that information, Dave, that the weakest like ARK and IPO haven't gone down more than the S&P? That somehow we're now near a bottom? Maybe. Or is this just a slight counter trend move in that ratio and a balancing out before the next move lower.
Yeah, when I look at, if I zoom all the way out, all 9
Which we should
years,
all do. Which we should all do.
IPO's been around for 9 years. You pull up that relative chart. You let me know if you're getting long IPOs here. That looks like a consolidation below or right below resistance to me.
Yeah, no, 100%. And that's why, yes, I agree with the statement or thesis that when the crappy things stop going down, you might be in the area of a bottom. That is very true. But it's only part of the truth. And I hate working in half truths. It's also true that that scenario can unfold in a counter trend nature until the trend reasserts itself. And you can see that some of these areas that had been weak, that have been equivalent since May 6th, May 9th of this year, now appear to be regaining momentum to the downside again. And so maybe we don't have a bottom in place, which seems easy to say now when we potentially have some bearish engulfing candles on a weekly basis in front of us. When we look at things like S&P 500 in the Qs and IWM, small caps, we've talked a little negative about stocks here. What about, let's say we are near a bottom, right? Because we should be open-minded.
Mm-hmm.
So maybe we're not, but if we are, we should be paying attention to where the strength is out of the weakness, right?
Yes.
So what do you think there? What are we seeing that is showing strength in this type of tape? And what I mean by this type of tape is,
so longer term, obviously energy now, energy getting walloped today. But if we're talking about this is a bottom, what leads the next 2 to 3, right? And you want to look for leaders coming out of this, what leads the next 2 or 3 years? I guess that also assumes if we come out of this and rates start going back down, maybe all this is thrown out the window. But we come out of this, drawdown in the broad indices, and market participants decide collectively that, hey, it's cool if rates go up, then probably more into a value area. Although solar has held up quite nicely.
No, for sure.
And another area that's held up quite nicely, and we can talk about ARC. You pull up the relative chart, small cap growth. IWO versus SPX. You would think, or at least I personally would have thought, it would look better given what's gone on in equities over the last month. Honestly, not shabby.
IWO?
Yeah, IWO versus SPX.
Okay.
I think it's not
yeah, still within the context of a major downtrend. But your point is it's held up since
And I guess
August.
small caps, small caps in general have held up a lot better than your large cap tech and NASDAQ.
Yes.
They broke to new relative highs. Well, and of course it's getting hit today as I say that. But
Well, and so the strength that we're seeing in the current weakness, it's really a lot of value. It's a lot of small, because even financials, which you guys touched on last week, and we touched on the week before that, but we're seeing strength out of utilities, strength out of financials, strength out of energy. The oddball, if you want to call it that, is solar. And if this market turns around, you could see those things really start to take off. But until that happens, everything is suspect. Because it's not like
agreed.
It's not like IWM is out of the woods.
No.
And it's not like financials are out of the woods. Like you take something like XLF below $35. I'm sorry, but there's more risk than reward there at this point in time. Now that can change in the next 6 months.
And I can say, same thing with energy you take XLE at 80. I love the relative strength, but like we said before, you don't need to sit there and lose less money than the S&P and call it a win.
Right. No, exactly true. And then, right, we've talked domestically. Now we've talked domestic stocks and where the strength is. The real issue is where the weakness is domestically, which is tech.
Like we said, it's fun on the way up, not so fun on the way down.
Right. And so you continue to see the largest sector struggle. And then, modern portfolio theory on you should always own international stocks. I don't know, man. You got emerging markets going out to brand new lows that we haven't seen since 2020.
Yeah, I mean, it's a great point. It's a great point. And this EEM 38, it's a dicey level.
It is.
Go back and pull that up long term. This 30, and we're not going to draw a pencil line at 38, but you pull it up, and your average technician knows exactly what I'm talking about.
Well, I think we have, a big portion of emerging markets like China.
China, yeah, which another area that it goes back to if you were going to short it, right? It had been the weakest area, particularly if you take something like Chinese tech. But look where it is since, the May 6th.
Right.
I guess a little bit better than some of the areas we mentioned, but for the most part, I'm going to give it a sideways rating.
Yeah.
Over the last few months.
You gain no advantage by shorting the weakest when the breakdown in the S&P happened on May 6th and 9th. And that's what makes it hard for a lot of asset managers who are taking those trades. And we might just be entering a period now, and this would be the irony, that they start to work. Because you're starting to see FXI, large cap, breaking to levels we haven't seen since March. We're seeing emerging markets overall breaking to new lows. We've talked repeatedly about Europe. I mean, there's not a lot of strength to find overseas.
No. Yeah, you've got an EFA, foreign developed in general, sitting on what will be new closing lows, I believe.
Yeah. Mm-hmm. If we close like this.
If we close here.
Yeah, we've got 90 minutes yet. So stocks continue to be in a downtrend. That includes international. We've got a situation with rates where we could be seeing the next iteration higher. It's not a prediction. It's just when you're above certain levels, it's the thesis for higher rates continues. What about commodities?
Oh, well, on your crude front, I guess the most important, we're below 95 still. So hard to believe there's going to be a new uptrend at the pump until that gets taken out. If you go to industrial metals, who are having an okay day today, but gold hanging on by a thread.
Right.
Oof.
Yeah, if we look at gold futures, currently sitting at 1683, really important at like 1695. Let me rephrase that or correct that. Really important levels at 1680. And if we close below that, the thesis for lower gold is confirmed.
Yeah. And silver, I think if you're below $21 on silver.
Yeah.
Same thing.
Right.
21, 22.
And your inflation hedges continue to disappoint.
They really do.
And if we're using some market expansion and contraction characteristics, basically since June, if we analyze what's been going on, we have S&P 500 flat since June. Now it's gone places, but it's flat. Commodities down. If we use something like TLT for treasuries, down. So you're in this environment where you're almost in stage 6, which means like complete contraction. Everything is moving downwards, commodities, stocks, and bonds. We're on the verge of that right now, of stage 6, which is true bear market behavior. Now, that model, that thesis doesn't include crypto, which I think is worth discussing.
Yeah, Bitcoin couldn't get it going. We had kind of the one-day pop. I guess it was more than one day. It was a couple weeks, but maybe like 7 days.
Well,
But
how,
we
cri-
are, I mean,
how
it's all
cri-
been wiped out.
yeah, how critical and important is that 18,780 level on Bitcoin?
Mm.
Ethereum right now, critical level at 1430. If we break that, we're probably revisiting the lows from July around 1,025. So here we have a scenario where you've got stocks weak, bonds weak, commodities weak, cryptos weak. Yes, within stocks, there's areas of strength, but really, isn't this a dollar story?
Dollar. Sure, one uptrend out there that's had took a few bumps in June, July, August with the equity rally, but again, until you're below 108, and we got there, actually maybe it was earlier this week. Was that Monday?
Well, and I mean, 108,
108 in Dixie, and then
108's a real near-term level. Aren't we really talking like 104? Because this is a
104 is really, yes. That's where your uptrend thesis would be negated.
And we continue to target 120 on the trade weighted dollar DXY, which would mean we're only halfway there because we're about 110, broke above a level around to 100, if I can use round numbers, which if we continue to see these other things be weak in a trade weighted dollar strength environment, if we're only halfway through the correction, that's something to be open-minded about. That if we see the dollar actually get to 120, 119, 119.50, what do stocks and crypto and commodities look like then?
Well, the last time we broke above 104 from below was March 2000.
Yeah.
Didn't get back below 104 until November 02, which was, I believe, pretty close to that middle bottom. I know a lot of indices had, I'll call it a triple bottom.
Yep.
But I want to say, like October, November 02 was the second of the three. And I'm sure you got like some great divergences going into the last one. I don't know. I wasn't portfolio manager then, but I can assume.
Well, you were, you just didn't know yet.
That's true.
But couldn't you see a scenario where we don't have a bottom in equities or commodities until we're at 120?
Oh my gosh.
Why wouldn't that be a thesis?
Yeah.
It's possible. And really, let's, if we're thinking binary, if this, then that, until we're back above 4180 at this point in something like the S&P 500, or, if you want to use the Qs, the NASDAQ 100, till we're back above 309, or if you want to use small caps, until we're back above, 195, there's really, the evidence continues to pile up for lower equity prices.
Well, and I would use, if we want to go outside the majors, something like...
Wait, are we talking like the isotopes? We're going to the minor leagues?
Like Value Line Geometric,
Yes.
I think on this latest rally had one of the most... I mean, it's a pretty solid. So you take Value Line Geometric. Well, you're going to use the equivalent of 4180 on the S&P, which here would be 590 on Value Line Geometric.
Mm-hmm.
Got above there for a day and then failed again. So again, your average stock confirming what the indices say. Correct.
The weakness underneath continues. I think we talked 2 weeks ago about the back and forth of breath that you get these 2+ days of.
Well, you said did we have a Whaley?
Yeah, we had a Lowry.
Lowry.
We had a Lowry breath thrust going into September 13th.
Handle was, yeah.
September 13th. So the prior 2 days were 90+ upside and 80+ upside back to back like that. That's a Lowry. And the rug pull on September 13th, it's impressive.
Well, and even to extend on that, so the 7th, so you had a 4-day span. You had an 83, 69, a 91, and an 86,
Mm-hmm.
followed by a 6% update. It's tough.
It is.
That's tough.
It's a rug pull. That's a Lucy.
That is.
She pulled the football, and you're on your back because those breath thrusts didn't stick. Immediately pulled it back. And right now we're staring a 80% down day in the face. We'll see how we finish up. Along with that, bearish engulfing. What does that mean? It's where the price action of this week compared to last week, we're engulfing the whole thing. It's overshadowing the prior week's price action, but to the downside. And so we have that scenario on our hands for lots of different broad indices on a weekly time frame. Now, similarly to the week prior, which had bullish engulfing, we would have to see follow through, right? Because we had bullish engulfing last week, didn't get follow through, also information. So now we have bearish engulfing on our hands. Do we see follow through? That's TBD, but I'll remind everyone we're seeing lower highs following 200-day moving averages. So the thesis of downward moving stocks continues. Ian, we've covered stocks, bonds, commodities, dollar, crypto. What are we missing? Anything we're missing that you want to cover before we roll out of here?
Like, say a few words on the conference we went to.
Oh, yes. Let's talk about future proof.
So future proof.
What was it?
So it was this they market as a wealth festival, kind of more of a new age conference for advisors, people in the RIA wealth management community. Very, I would say, pretty different than your typical, like if you've been to Schwab Impact, or a few years ago we went to, what was the TD one down in Orlando. So I'm not saying that different in regards to content. Well, the content was different. There was lots of content and sessions and networking and having fun and all those things, but a very different vibe, I would say, than you would have expected. Maybe.
Well, they got us outdoors, right? They got us outdoors. The
outdoor aspect was, and of course, I mean, it's Orange County, California. Weather was amazing.
But we weren't sitting inside in hyper air conditioning, trying to stay awake, listening to the same panelists. They did a good job commingling the individual stages being like where people presented information amongst solutions providers. Some people call them vendors. I would call them solutions providers. And there was a lot of third parties there.
Yes. A lot of good, again, to use your term, solutions providers there. Some we use, some aren't really down our alley, but the selection and quality, I think, was pretty impressive.
Yeah. And what was nice for us, selfishly, was we were able to make some connections with individuals and companies that we really wanted to meet in person, just from some things we're working on. And so it was really great to meet them there.
And some relationships I can think of one in particular, we're not going to get into it, but people you end up networking with where, beforehand, I never would have thought that relationship would have budded. And then we ended up in California and things happen, right?
No, 100%. And so, it's like every conference from the standpoint of there's going to be nuggets, which we definitely got. There's going to be some stuff that wasn't up your alley. That was also the case. But the difference was being outdoors, not being inside windowless places, being close and intimate with those who are presenting information, but also close to people who are providing solutions. It was well done. So I give Advisors Circle congratulations on that.
Next year, don't put the technical analysis panel at 8 a.m., please.
Yeah, right. And that's what
they deserve more respect in that.
Yeah,
We made sure to go and show our support. So
right, and I'll say this: like, it tells me where our edge is at.
Yeah.
When the majority of the information being provided is fundamental.
Very few advisors interested in technical analysis.
Yeah, and that's fine by me. you know.
Also, it seems that based on we're still one of maybe the only advisors with a metaverse office, but
Yeah,
that's a discussion for another day.
it is. All right, awesome. No, it was great to see you at that, Ian. I know we always enjoy seeing each other in person when we're together, which is great. We bumped up against the edge of our time. If I can re-pump up the opening commercial, if you are having your heart tugged and you want to find a way to support other organizations that are experts in helping others have an abundant life, whether it's getting pulled back out of sex trafficking, whether it's helping through pregnancy counseling or depression, anxiety counseling, or foster care, check out beatsforheartbeats.com. Please help us get from 35,000 to 50,000. It'd be really appreciated. Ian, as always, it's a pleasure. Great to be back on here with you. Thank you.
Thank you, Dave, and have a great weekend, everyone.